Greetings everyone and welcome to the lesson. We continue with our studies in public finance and taxation. In our today's session, we are going to start on a new topic known as Introduction to Taxation. This topic has 10 subtopics. Number 1, definition of tax, taxation and types of taxes in Kenya. Number 2, history of taxation. Number 3, classification of taxes, tax shifting and factors that determine tax shifting. Number 4, principles of an optimal tax system. Number 5, types of tax systems, single versus multiple tax systems. Number 6, purposes of taxation, why the government levy taxes. Number 7, tax evasion and tax avoidance. Number 8, taxable capacity. Number 9, budgetary and fiscal policies. Then lastly, the Revenue Authority, structure, functions, large and medium taxpayers office mandate. These are 10 subtopics. We will be studying each subtopic at a time. In our first lesson, we're going to look at the definition of tax, taxation, and types of taxes in Kenya. So by the end of this lesson, you should be able to define tax, should be able to define taxation, and you should be able to outline the types of taxes in Kenya. We are going to begin with the definition of tax. Definition of tax. Definition of tax. What's the meaning of the word tax? Now, tax is a mandatory financial charge or levy imposed by a government on individuals, businesses, or other entities to fund public expenditures and public operations or government operations. So a tax, number 1, is a mandatory financial charge. It is a mandatory financial charge or levy It is, number 1, mandatory. Number 2, it is imposed by a government, and this charge is on individuals, businesses, or other entities to fund government operations, all right, to fund public expenditures and government operations. So a tax is a mandatory financial charge or levy imposed by the government. Number 1, it's mandatory, it's a must. When the government decides to levy a charge on individuals, then individuals have no option but to comply. And the reason why a government levies these charges is so that the government can fund its expenditures. The government can fund its operations. Because candidates, for a government to run, for the government to offer services, for government to offer public goods, the government needs money. And that money, one of the sources of such money is tax. So it is a charge on businesses, a charge on individuals, but is a form of revenue on part of the government. It is a form of revenue on part of the government. For example, for the government of Kenya, I want to refer you to the Constitution, which is a contract between the people of Kenya and the government. The Constitution empowers the government to impose taxation. The government derives its power to raise revenue from businesses, from individuals, from the Constitution. And Article 209 reads, only the national government may impose A, income tax, B, value-added tax, C, customs duties and other duties on import and export goods, and D, excise tax. So you can see, candidates, the government has the power to impose taxes and charges, and this power is derived from the Constitution. That's why when the government decides to raise taxes, the people have no option but to obey. The reason being is the Constitution that empowers the government to do so. Apart from the national government, I read from this article that a county may impose A, property rates, B, entertainment taxes, and any other tax that is authorized to impose by an act of parliament. So the national government and county governments may impose charges for the services they provide. So candidates, the government provides many services, many public goods. The government builds roads, hospitals, the government builds schools, and so on. That requires money, and one form of raising such money is by imposing taxes on individuals, imposing taxes on businesses, imposing taxes on other entities. So tax, in other words, is a primary source of revenue for the government at the national level and the county level. And it's typically based on, it's typically collected based on predetermined set of rules and rates. And there are very many types of taxes which we'll be discussing, and we've read a few here from the Constitution. One is income tax, that's a type of a tax. B is value-added tax, a type of a tax. Customs duties and other duties on imports and export goods. Then there is also the excise tax. The county governments can also raise another form of tax which is known as property tax or property rates. There is entertainment taxes and any other taxes. So taxes are used to finance essential public services such as education, healthcare, infrastructure development, defense, social welfare programs, and so on. Do you understand? That's the meaning of tax. I repeat, it is a mandatory financial charge or levy imposed by the government on individuals, businesses, to fund public expenditures and government operations. The government offers public goods, public services. The government also has employees who are paid salaries. So these salaries are paid out of the tax that is raised from individuals, from businesses, and other entities. Now, in defining taxation, I want us to look at the elements of tax elements. Elements will help us understand the meaning of tax. Elements. One element is taxpayer. Taxpayer. Now, a taxpayer refers to an individual or a company that is responsible for paying taxes. An individual is may be a taxpayer. A company can be a taxpayer. A business can be a taxpayer. So a taxpayer refers to individuals or entities that are responsible for paying taxes. Like companies are responsible for paying corporation tax. Individuals are responsible for paying income tax, and so on. Another element of a tax is a tax authority. Tax authority. Tax authority. Now, the government or a government body, a tax authority is a government or a government body that is established and enforces tax laws and regulations. Like here in Kenya, we have a tax authority known as the Kenya Revenue Authority. That is a government body or department that enforces tax laws and regulations. The National Parliament may pass the legislation, or as we read from the Constitution states that the government may raise revenue or impose revenue. I mean, may impose taxes on goods. The government may raise taxes from customs, duty, and so on. That is law, but that law has to be enforced by an authority. So in Kenya, there is established an authority known as the Kenya Revenue Authority that enforces tax laws and regulations. Number 3, tax base. Tax base. Now, this refers to the specific item. Tax base refers to the specific item, activity, or transactions that are subject to taxation. For example, we've read income. Income is a tax base. Property value is a tax base. Or purchase of goods and services. So tax base refers to the specific item or activity or transaction that is subject to taxation. 4, tax rate. Tax rate. Tax rate is a percentage or a fixed amount of money applied to a tax base to determine the tax liability. For example, the income of a company. In Kenya, we apply a tax rate of 30% to determine the corporation tax. A tax rate may also be on value of goods, value added. Kenya value added tax rate is 16%. So 16% is a percentage, 30% on corporation tax is a percentage, and it's a percentage of money applied on the tax base. So income is a tax base. So the tax rate is applied on a tax base. For incomes of companies, it is 30%, tax rate of 30%. The tax base is income. So tax rate is a percentage of money, is a percentage or a fixed amount of money applied to the tax base in order to determine the tax liability of either an individual or a business. Tax rate. 5. Tax liability. What's the meaning of tax liability? Tax liability is the actual amount of tax owed by the taxpayer, calculated by multiplying the tax base by the tax rate. So this tax liability will be equal to the tax rate times the tax base. If it is corporation tax, then the tax liability of a company will be the tax rate, 30%, times the income, which is the tax base. So tax liability, candidates, is the actual amount of tax owed by a taxpayer. And we define the taxpayer, candidates, as an individual or an entity responsible for paying tax. So tax liability is the amount of tax owed by the taxpayer, calculated by multiplying the tax rate by the tax base. 6. Tax filing. Tax filing is simply the process by which taxpayers report their income, report their expenses, as well as deductions, in order to determine their tax liability. In order to do what? To determine their tax liability. And that may involve the submission of tax returns or other relevant documentation. So are you following the flow? These are elements. I'm explaining all these elements so that you be in a position to understand clearly the meaning of a tax. Elements. I began by explaining who a taxpayer is. Tax authority, tax base, tax rate, tax liability. So once the liability has been determined, then a taxpayer is required to file returns. Then lastly, tax collection. Tax collection. Now, tax collection is a process of collecting taxes from employers, from taxpayers, and that process is carried out by government agencies like the Kenya Revenue Authority. Tax collection is a process of collecting taxes from taxpayers. And we say that these taxpayers could be individuals, businesses, or other entities. So these are elements of taxation or tax. Now, having understood the meaning of tax, then what would be the definition of taxation? What is taxation? Now, if a tax is a mandatory financial charge imposed by the government on individuals, businesses to fund public expenditures and government operations, then taxation will then be the process or system by which a government collects revenue from individuals, businesses, or other entities to finance public expenditure or government operations. It is, in other words, the means through which the government raises funds to provide essential public services, to maintain infrastructure, to support social programs, and also to fulfill its various functions. So taxation, candidates, taxation is the process. It is the process or system by which the government does what? By which the government collects revenue from individuals or businesses to fund public services and government operations. That's the meaning of taxation. All right. Now let us move on to outline the types of taxes in Kenya. Types of taxes in Kenya. Types of taxes. Types of taxes in Kenya. Types of taxes in Kenya. We are going to outline the types of taxes in Kenya. Now, Kenya has a variety of taxes. There are various types of taxes in Kenya that are imposed by both the national government and the county government. We read from the Constitution that the national government has the power to impose taxes. And we read some of the taxes in Article 209. Power to impose taxes. Only the national government may impose income tax, value-added tax, customs duties, and other duties on export and import of goods, excise tax. Then we also read that a county may impose property rates, entertainment taxes, and any other tax. So those are the main taxes, the main types of taxes, main types of taxes. The first one here is the income tax. Income tax. Let me use my blue pen. Black pen. Income tax. Income tax. All right. That's the first category, income tax. Now, candidates, the income tax is levied on individuals. Individuals are taxed on their incomes based on a progressive tax rate, with the higher earners paying a higher percentage of their income. Businesses and corporations are also taxed on their profits at a standard rate in Kenya at the moment, 30%. So this is one type of tax, income tax. We have personal income tax, then there is the corporate income tax. Do you understand? Types of taxes. Number one, income tax. Then number two, value added tax. The value added tax. Value added tax. Value added tax. Number two, the value added tax. Now, VAT is imposed on supply of goods or services, and this is done at various stages of production and distribution. So the standard rate is applied to most goods and services, while certain items may either be exempt or subject to a reduced rate. So there are certain, most of the goods are charged at a certain rate in Kenya at the moment, 16%. But there are certain goods that are exempt from VAT. Others are charged at a reduced rate. So VAT is another type of tax in Kenya. Withholding tax. Withholding tax. Withholding tax. Withholding tax. Withholding tax. Now, withholding tax is a tax that is deducted on or at source. It's a tax that is deducted at source on certain payments made to individuals or businesses, such as dividends, such as interest. Interest that is paid to shareholders may be deducted at source by the company that pays the dividends. Interest, royalties, and so on. Withholding tax. This is the tax that is held or at source. For example, I've given an example of interest. We may have withholding tax on dividends, withholding tax on royalties, and so on. Withholding tax. Pay as you earn. Pay as you earn. Pay. Pay candidates, which stands for pay as you earn. Here, employers are required to withhold a certain proportion of employee salaries and remit it to tax authorities as pay as you earn tax. So it is just part of the personal income tax, which is in form of salaries. Employers are required to withhold a portion of the employees' salaries and remit it to the tax authority. So it is a form of a tax. Pay as you earn. Pay as you earn. Property rates. Property rates. Property rates. Let me write clearly. Property rates. Property rates. Property rates. Now, we read in Article 209 of the Constitution that county governments are empowered or are authorized to impose or to levy rates on land and buildings within their jurisdictions. So property rates is yet another type of tax that is raised by county governments. Capital gains tax. Capital gains tax. Capital gains tax. Capital gains tax. Capital gain tax. Capital gain tax. Capital gain tax. Capital gain tax. This is a tax that is imposed on the gains realized on the sale of certain assets. right? Such as real estate and also shares. When you buy an asset, or say land at say 10 million, then you sell it at 15 million, then there is a gain of 5 million. That 5 million is taxed. The tax that is levied on the gain is known as capital gain tax. Turnover tax. Turnover tax. Turnover tax is yet another type of tax. This is where small businesses with an annual turnover below a specified threshold may be subject to turnover tax, which is a simplified tax regime. So a country may say a business that has turnover or sales, annual sales of say 10 million should pay a turnover tax of say 1%. So it is a form of a tax, turnover tax. Stamp duty. Stamp duty. Stamp duty. Let me maintain my stamp duty. Stamp duty. This is a form of a tax on legal documents. Is payable on various legal documents such as land transfers, leases, and certain agreements. Stamp duty. Stamp duty. Next, customs duty. Customs duty. Customs duty. Now, this is a tax. Customs duty is a tax or a tariff levied by the government on goods being either imported or exported across international borders. Customs is a tax or tariff imposed by the government on goods being imported or exported across the borders. And it's imposed to control the flow of goods, to protect domestic industries, and to generate revenue for the government. So, customs duty is applied, candidates, on imported goods when they enter a country's customs territory, and sometimes on exported goods leaving the country. Customs duty. Then there is import duty. Import duty. Import duty. Import duty. Now, import duty is a type of tax imposed on goods imported into a country, and it is just part of the customs duty. It's part of customs duty, specifically focusing on taxes imposed on imported goods to protect domestic industries, to regulate trade, and also generate revenue. So import duty is part of customs duty. Then we have excise duty, a very important one. Excise duty. Excise duty, important because it is part of what is included in Article 209 of the Kenyan Constitution. Excise duty. Now, excise duty is a type of indirect tax imposed on specific goods manufactured or produced within a country. You understand? On specific, it is a tax on specific goods. And unlike the customs duty, which is applied at the border, excise duty is imposed on certain goods within the country and is often associated with items that could pose a health or social risks for which the government wants to control consumption. That is excise duty. So excise duty, in other words, is imposed on goods produced domestically, typically on items such as alcohol, tobacco, fuel, and certain luxury items. So candidates, these are some of the types of taxes in Kenya: excise duty, capital gains tax, turnover tax, stamp duty, customs duty, income tax, which you said could be personal income tax or corporate income tax, import duty, value added tax, withholding tax, pay as you earn tax, property rates. So that will mark the end of our today's lesson, where we've introduced the chapter on taxation. We've defined taxation in this lesson. We've defined tax. We've also outlined the types of taxes in Kenya. Thank you for attending the lesson. I'll, before close the lesson, give you an assignment. Number 1, explain the concept of tax and how it differs from other forms of government revenue collection. Number 2, outline the major types of taxes imposed in Kenya and briefly explain each. 3, how are taxes classified in Kenya and what distinguishes direct taxes from indirect taxes? Thank you for attending the lesson. I'll meet you in our next session, where we continue to study the subject taxation. Bye-bye.